You know that feeling when you're staring at a market chart and it just looks like complete chaos, a storm of random, unpredictable price swings? Well, what if I told you there's a hidden logic to it all, a story that's being told right in front of your eyes? In this explainer, we're going to learn how to read that story.
I mean, this is the big question, isn't it? The one we all face. Is there some kind of method to this madness, or are we all just taking a wild guess? Because let's be honest, for most people, this constant up and down just looks like pure, incomprehensible noise.
But this is where legendary trader Jim Dalton comes in. He saw something different. He argued that we're not looking at random noise at all. What we're actually watching is a highly organized two-way auction. And his entire philosophy is built on this one simple idea. If you can learn to read the auction, you can start to understand what the market is really trying to do.
So here's our game plan for breaking down Dalton's approach. We're going to start with the big idea, the market's hidden story. Then we'll get into the most important concept, finding the value area. After that, we'll dive into the two states the market is always in, balance versus imbalance. Then we'll get practical, showing you how to read the clues and trade the story of the day before we finish up with what might be the most critical piece of the puzzle, the right mindset.
Okay, so this first idea is a really huge mental shift. Dalton's whole approach asks us to stop looking at technical indicators that are always lagging behind. Instead, he wants us to focus on understanding the context, what the buyers and sellers are actually doing right now. In other words, it's about reading the room, not just looking at the price ticker.
And the foundation for reading that room all comes down to this one single concept. Seriously, if you can wrap your head around the value area, you'll get the absolute core of market profile.
So what is the value area? Well, it's simply the price range where the market spent the most time and where the most volume was traded. But here's the key psychological part. This area is where buyers and sellers have basically reached an agreement on what a fair price is. You can think of it as the market's comfort zone.
And get this, typically, about 70% of an entire day's trading volume happens inside this value area. Now, this isn't just some random number. It's actually based on a normal distribution, a bell curve. It represents where most of the action is. It's like the market's gravitational center. Sure, prices might wander away from it, but they often feel this really strong pull to come back to this zone of accepted value.
All right, so now that we have the value area as our anchor, we can start to look at the market's two fundamental states. Dalton argues that every single market on every time frame is either in a state of balance or a state of imbalance. It's this constant tug-of-war that drives all price movement. The real trick is learning to spot which state you're in. A balanced market, like you see on the left, is rotational. The price is just kind of chopping around that value area. The strategy here? You fade the extremes. You sell near the top, you buy near the bottom. But in an imbalanced, trending market, it's a completely different game. The price is actively searching for a new value area, so your strategy has to be to go with that trend, not against it.
Okay, so we know what we're looking for, balance versus imbalance, but the big question is, how do we tell the difference when we're in the thick of it? This is where we get our hands dirty with the practical tools for reading the action as it's actually happening.
This is basically our day trading toolkit. 3 key reference points we need to watch. First up is the point of control, or POC. That's the one single price where the most trading happened, the fairest price of the day. Next is the initial balance, which is the range the market sets in the first hour of trading. And finally, we have to learn how to read the story at the edges of the market, what Dalton calls excess and poor structure.
Okay, so when you see excess on a chart, it usually looks like a long tail at a high or a low. That is a huge clue. It means the auction at that price was fast and decisive. The price was aggressively rejected. This is a big signal that we might have a turning point, telling you the auction in that direction is probably done.
Now let's contrast that with the exact opposite signal, a poor high or low. This is what happens when the market goes up to a certain level and then just fizzles out. There's no sharp rejection, no tail. This lack of excess is a massive clue. It suggests that the auction isn't finished and that there's still unfinished business at that price. And what that usually means is the market is probably going to come back and test it again.
So now we can start putting all these little clues together. See, it's not about using any one signal by itself. It's about combining them to understand the story, the narrative that the market is trying to tell us in real time. And this is how you match your strategy to what the market's doing. If you see a powerful break of that first hour range, it's very likely a trend day, so you trade the pullbacks. If the price is just hanging out inside the value area, it's a normal day, and you focus on trades that revert back to the mean. And if the range just isn't expanding at all, it's range-bound, and you go back to fading the extremes. Simple as that.
And you know what? This same auction logic applies to common things like market gaps. A gap and go shows there's huge conviction. A gap fill tells you that all that opening excitement was wrong and the market is coming back. But the most powerful of all might be the failed gap, because it traps a ton of traders and their panicked buying or selling can fuel a really strong move in the other direction.
So we've covered the tools, we've covered the tactics, but honestly, none of it really matters without the right philosophy to back it all up. This final section is, I would argue, the most important part of making any of this actually work.
Now, this next idea, it goes against everything most of us are taught about trading. Dalton's entire approach is built on the belief that trying to predict the future is a fool's errand. The goal is not to guess where the market is going next. The goal is to understand the current context. Is it in balance or is it in imbalance? And simply adapt our strategy to what the market is doing right now.
And this quote from Jim Dalton just nails the kind of discipline this takes. He said, "Patience is waiting for the market to come to your level." You see, all those reference points we just talked about, the value area, the POC, a poor high, those are your levels. The real discipline is not chasing the market around in between them. So I'll leave you with this question. When you look at a chart, are you trying to read the auction? Are you trying to understand the story the buyers and sellers are telling you? Or are you just chasing the price? Because as Jim Dalton's work shows us, the difference between those two approaches, well, it's everything.